Here are 4 accounting mistakes small business owners make. Number 1, not reviewing your numbers on a weekly basis. This is a problem because you'll be running your business blind. If you don't know your revenue, if you don't know your cash position on a week-to-week basis, you don't know if you're making profit, you don't know if you're making a loss. Reviewing your numbers weekly also helps with planning, so you can plan ahead your cash flow and you can plan ahead what type of jobs you take on as a business. Number 2, using a Word document or a free invoice generator to generate your invoices. Not using an accounting software means that you can't take advantage of some of the automation that they provide. You're not able to add payment gateway links, and there's a duplication of work as well because you're creating invoices manually and then you have to add it to the accounting software later on. Number 3, not getting paid on time. There are very simple steps small businesses can take to ensure that they get paid on time. Some of these are ensuring that they have a PO whenever they start a new work. These POs can also be generated from their accounting software. They can also have automated invoicing from their accounting software. So if they have recurring billing, that can go out every month. Small businesses can also encourage early payment by offering discounts and also penalties for late payment on their invoices as well. Number 4, having an admin person do your accounting. This is a big mistake because having someone who's not qualified to do your accounting can lead to penalties because they simply will not do your accounts correctly. It's very easy for a non-accountant to have hidden transactions in your books and you won't be able to find them. Ultimately, your books are going to be wrong. So your profit and loss is going to be misleading, and any data you use for forecasting purposes is likely to be wrong. If one of these problems resonate with you, give us a call and we're more than happy to solve these for you.